Welcome back to the Mountain Morning Show. I'm pleased to be joined by Travis McGhee of FuturesANIMal. Hello.
Happy snowy morning to you, Joe.
Happy snowy morning to you. You're dressed warmly for it, though. So
I'm trying to stay warm.
Indeed.
Threw me off a little this morning, though.
Yeah, and you still got the March hair in.
Yeah, I think I'm just going to let it go.
Yeah, it's a good insulator for this time of year.
It absolutely is.
You look great.
Yeah.
Well, thank you so much for being here, because one of the things that I've some of my friends have been asking me about and I wanted to talk to you about is the difference between the perceived advantage, and maybe it is an advantage, so I guess that's the point, of the big companies that are out there trading and guys like you and me.
Right. Well, the reason your friends are probably asking, so I'm sure most people, there was a 60 Minutes episode on Sunday night. Regarding a book being written, many people know the author, Michael Lewis. He's written a number of different books, Moneyball being one of those, which they did a movie after and everything. But most recently wrote a book regarding the stock market, and specifically regarding what's called high-frequency trading and this perceived notion that the stock market is rigged by larger institutional players who have a lot of money, who can then use that money to buy very, very expensive equipment, which will essentially get them to the market faster than you and I can get to the market.
And we're talking in thousands of seconds.
Millisecond of an advantage. And basically, without going over people's heads, so when you hear high-frequency trading, what it is it's typically professional institutions, again, larger people with huge computer databases that are using algorithms, mathematical equations, to execute trading strategies that will go to the market and essentially get to the market before you can get to the market. So I want you to look at it this way. So think about U2 is announcing a new concert tour, and they're about to sell tickets for it. But I hear about this concert just slightly before you do. So I jump in front of you in line and buy my tickets, and then I buy all those tickets, and then I turn around and I sell them to you for a higher price. That's what high-frequency trading is. So they're buying stocks a millisecond before you and I are buying them, then they're turning around and they're selling them for just a fraction of a cent. Now you think, okay, well, a fraction of a cent, that's no big deal.
But this is huge volume.
But if you're doing that millions of times a day on very large volume, that adds up very, very quickly. And that was the whole thesis behind Michael Lewis in the interview he gave in 60 Minutes about saying that the stock market is rigged, is that essentially if you have the money and the power to buy this equipment, there's nothing stopping you right now. There's no regulation. The government, there's no laws preventing you from going out and accessing data, accessing information faster than the retail investor.
So this is for real. It's happening.
Oh, it's happening. It's been happening for years. It's everybody knows. I mean, this isn't groundbreaking news by any means. Now, it's groundbreaking news for most investors who aren't in the market day to day looking at this stuff and hearing about it, but it's been out there for a long time.
Should this be regulated?
In my opinion, absolutely it should be. Everything else on Wall Street is regulated. It really doesn't make much sense why this is not regulated as well. Now, the problem I have with it, and particularly the problem I have with the interview on Sunday and so on and so forth, is that at the same time it also evokes a lot of unnecessary fear. And it scares the retail investor, and it essentially pushes them out of the market, saying, well, you shouldn't be involved because it's rigged, you're not going to win anyway. Well, let's think about it for a second. I mean, majority of investors, average investors, folks like you and me, when we buy our stocks or bonds or whatever it is that we're purchasing in the market, we're holding that for a significant period of time. So a fraction of a cent really is not going to make that much of a difference to you or I. What we're going to do.
Because we can't trade.
You're already paying commissions. You're already paying other exchange fees. There's all these fees already in there. So a fraction of a cent, you're not trading that type of volume. You're not trading in that type of a rapid motion to where that's really going to affect you whatsoever. The basis of the interview was just the principle of, okay, there is a group of people that have a unfair advantage over another group of people.
Indeed.
That's the basis.
And we kind of always assume that people with more money are going to have that advantage typically.
Right.
Well, one question that it kind of drives back to something we talked about a couple of weeks ago. I asked you, the market swings sometimes on these massive trades, right? How does that affect us?
Well, it affects us greatly. I mean, again, the market is far more volatile now because of how much of the market is being controlled by these high-frequency traders, larger institutions, than it was in the past. And again, these algorithms are very sensitive to information. So if the dynamic of the market isn't conducive to what the algorithm wants or needs in order to function, it's going to shut down and essentially pull out of the market. Well, when you have this group of people who make up 75% of the market, you see events like the flash crash in May of 2010.
Right.
You know, that right there is an example of what can happen if these algorithms and these high-frequency traders pull
So the
out
regulation is probably better for preventing that from happening than it is from helping you and me to make more money or to keep from losing those little fractions.
Yeah, although the headline wants you to think it's more about protecting retail investors, it's really about making the market function in a way that's relatively safer than the way it is right now.
The volatility of the market is the part that's certainly scarier.
Yeah, absolutely. Absolutely. That's going to affect you far faster than a fraction of a cent on a stock. You know, if the market, like in 2009, drops 400 points in a matter of, a minute.
How do we best protect ourselves from that?
Well, again, the key is having a plan and making sure that you understand exactly what it is that you hold inside of your investment portfolio at any given point in time. And using some of the tools out there that are available to you now for protection, whether it comes in the form of options and whether it comes in the form of stop losses on your stocks, whatever the case may be, making sure that you have proper protection there in case something ever does arise, and pushes things significantly to the downside.
Having someone help you do that, always a good plan. That's why we have Travis McGhee right here from FuturesANIMal. Thanks again for some fascinating information.
It is fascinating.
Love breaking it down though and having a little better understanding of it.
Yeah.
Yeah, not all the headline hype.
Yeah.
All right, well, we're going to be back with more. Lindsay Malone's here, Explore, and much, much more. All that's coming up right here on the Mountain Morning Show.